Hello, and welcome back to another lecture series. Uh, in this series of videos, we're going to be talking about Chapter 3, which is job order costing, but we're going to be looking at how the costs flow through the accounting system, and we're also going to look at external reporting. So this chapter really builds on the previous chapter. Like I mentioned in class, if I remember correctly, previous books um, did not break down job order costing into two chapters. It was all in one. So why they broke it up into two, no idea. But nonetheless, we're going to work with it and we're going to see how these costs flow through the job costing system. Now, I know there was a lot of uh, uh, hesitation, I guess, or uncertainty as far as like journal entries and things like that. And some students were worried about financial accounting principles 1 and the Harvard Business Review. Put all that crap out of your head. All right, it's brand new. We're going to go through everything. I'm going to explain it as if you did not even have financial accounting principles or that Harvard Business Review. Okay. Um, Keep in mind, so forget all that crap. We'll worry about what we have here. We'll treat it like you know nothing. Um, and if you do what you do know, great. What you don't know, that's okay because we'll explain it. And if you have any issues as we're going through this and you're watching this, jot down your questions, text me, say, hey, I want to talk about this chapter. Not a problem. Remember, no question is stupid. I am here to help you to learn this stuff. So please don't feel shy or whatever. I'm here to help you. All right. Having said that, let's jump into job order costing, looking at cost flow. Now, the first thing we need to recognize here is that there's some vocab words that we're going to need to learn. So let's just go through those, okay? Job order costing, we already know what that is. We learned about that in chapter 2, right? It's a costing system. It's one of the many costing systems we're going to learn in this class. But job order costing is used in situations where we make a number of different products, or perform a number of different jobs, or provide a number of different services, okay, during a period. All right, that's it. We're just doing a bunch of different stuff and we have to keep track of costs for each of these different projects or different jobs or different services that we have, okay? Now, absorption costing. I'm hoping this is familiar because if you can remember back to financial accounting principles, absorption costing it's a costing method, right? And it includes all the manufacturing costs, okay? Absorption costing is what we use for external reporting purposes, okay? So for right now, all you really need to know, which you should know job order costing because we talked about that in the last video. Absorption costing, again, another costing method, but this time it includes all the manufacturing costs. Based on chapter 1 and our first meeting, hopefully you still remember or can recall what those manufacturing costs are. Direct material, direct labor, and all of manufacturing overhead. Remember, manufacturing overhead is going to have some pieces that are variable, and the manufacturing overhead is also going to have some pieces that are fixed, right? We saw examples of that in chapter 2. So as long as we have that in our mind, recognizing that, okay, we know what manufacturing overhead is, it's all the indirect costs, but they all behave differently. Some behave variably, some behave fixed, some may be even mixed, okay? So now we need to look at some of the calculations, right? Again, this should be review from chapter 2, right? We know what the allocation base is. That's our cost driver, so to speak, right? What is the allocation base? Well, it's nothing more than a measure of activity, right? Last chapter we saw direct labor hours, we saw machine hours. Remember, we could also use direct labor dollars, right? But basically this allocation base is the measure of activity that we use so we can assign cost to cost objects, right? Well, what costs are we assigning? We're assigning manufacturing overhead costs. We already talked in chapter 1. We know what cost objects are. It's a job, a product, a service, maybe a department, whatever, right? In general, a cost object is anything that we want to collect cost data on, okay? Predetermined overhead rate. We already know what this is. We learned about it in chapter 2, right? That predetermined overhead rate, basically it's a rate that we use so we can allocate manufacturing overhead to jobs, right? This predetermined overhead rate, we estimate what our costs are going to be, so we establish it in advance of the period. At the beginning of the period, we got to calculate our predetermined overhead rate, okay? We should know how to calculate it, right? Just as quick review, we take the predetermined overhead rate equals that estimated total manufacturing overhead, okay? Remember, estimated total manufacturing overhead includes both variable and fixed portions of that manufacturing overhead. We then divide that estimated total manufacturing overhead cost by the estimated total allocation base, whether it's direct labor hours, machine hours, whatever. We divide those two. That's how we get the predetermined overhead rate. Okay. We did talk about applying the overhead, right? We should know how to apply predetermined overhead rate. We said that in order for us to assign those overhead costs to a specific job or a specific product, we need to use a formula, right? I hate using that vulgar F word, formula. That's okay. Don't get intimidated. It's easy, right? We just got to commit it to memory, and it's easy, right? There's no funky calculations. It's straight, direct multiplication. We just need to know what we're multiplying. Well, to apply overhead, what we need to do is we need to take the predetermined overhead rate that we already calculated, and we multiply that by the actual amount of the allocation base that the job incurred. In other words, if the allocation base is direct labor hours, okay, how much actual direct labor hours did we use on this job, or on this product, or for this service? Actually, how many machine hours did we actually use, right? I'm taking that actual and applying it to the predetermined overhead rate, okay? We know what a job cost sheet is, right? That job cost sheet is a nice little sheet that allows us to keep track of our direct material, direct labor, and the manufacturing overhead costs that we assign to a job or a product or whatever. Now we got this thing called normal costing, right? What is normal costing? Well, normal costing is nothing more than a costing system, right? But here we take the overhead cost and we apply it to a job by multiplying a predetermined overhead rate by the actual amount of the allocation base incurred by the job. Well, wait a minute. Normal costing is the same thing as overhead application, okay? So try not to get confused. They're synonyms for one another, right? Applying overhead equals normal costing, okay? So now what we want to do, we kind of want to switch gears here, and we want to look at how costs flow in the job order costing system. We want to prepare some journal entries, but more importantly, we're going to use the T accounts. Now, if you've never seen a T account, you are in for a treat, because T accounts are sexy, right? I love T accounts. As long as I've been working in accounting, I still use T accounts. In fact, the other day I had to figure something out. Guess what I did? Drew my T accounts. We'll see what those are, but we can use those to show how costs flow through a job order costing system. Okay? So, real quick review here. We have some key definitions, and we kind of talked about these during our first meeting, right? We discussed raw materials, right? We know what a raw material is. It's any material that becomes an integral part of the final product, right? We use the example of car radios, right? We're Ford, we're making trucks or cars, whatever. We call Bose or Sony, and we say, hey, we need a radio. That radio or transistor, whatever you want to call it, is a raw material for our truck or car, right? We talked about work in process, aka WIP, right? These are units of products that are only partially completed, right? We still need to add something to that piece, right? We either need to add direct material, direct labor, or we need to apply some more manufacturing overhead before that job or that product or that service is actually ready for the customer, okay, or it's actually ready to be sold, right? Once we complete the product, it moves from WIP and it goes into the finished goods account, right? Finished goods, hey, these are completed units of a product, right? They just haven't been sold yet. Think of it as a bucket. It's completed good that's just waiting for a customer to come buy it. Okay. Later on in this chapter, we're going to see how to prepare the cost of goods manufactured statement. The cost of goods manufactured statement is a statement that includes all manufacturing costs that are associated with the goods that were finished during the period, right? So we have a quarter, right? And we're producing products and then they finish, right? Well, this statement or this cost of goods manufactured lets us know all the manufacturing costs that are associated with this finished good for the period. Okay? Now, this is beautiful, right? Step one for your learning objectives. You got to know how the costs flow, okay? We have some production costs, right? We have raw materials, we have direct labor, and we have manufacturing overhead, right? Well, these costs, as they physically flow through the plant, I want you to think as all these products or all these parts and pieces are physically flowing through the processing plant or the shop floor, right? In your mind, I want you to attach dollar signs to them because as they flow through the process, they're going to flow through the accounting cycle or the accounts. Okay, so raw material purchases. Anytime we purchase raw materials, radios for our cars, wood, glass, bricks, because we'll stick with that example of making houses, right? Well, we need to buy 2x4 so we can make the frame, right? We need concrete or cement mixture so we can lay the foundation, right? We need various building materials, shingles, bricks, what do you call it? Siding, right? So anytime we purchase raw materials, it sits on a balance sheet under an account called raw materials inventory. It just sits there, okay? So let's go through the steps here, right? So we buy raw materials, on the balance sheet, we hit our raw materials inventory account, okay? We know that we have a materials requisition form that says I need all these parts so I can start working on this job, right? We take it to the raw materials inventory area in the plant and we say give us all this, give us 2x4s and shingles and bricks and cement and all this stuff, right? Once it physically leaves that area and flows to, we'll say, the job site, okay? I want you to think of the job site as a bucket. And that job site is where we actually build the house or the product, okay? And as those physical pieces flow to that job site, that job site, that's that bucket that's holding all our costs, we're going to call that WIP, our work in process inventory account. So what happens is, as those materials leave the raw materials inventory account, they go into our work in process inventory account. That's what happens on the accounting side. In the real world, we're taking our material, we're loading on a truck, and we're driving to the job site, right? That's our work in process. Okay? While we're at the job site, we're going to incur direct labor, right? We need carpenters to build the frame of the house. We need a cement person to come in and mix the cement so we can lay the concrete, right? That direct labor cost flows to the job site. Well, remember, for the accounting system, we said that job site is actually our work in process bucket, or our work in process inventory bucket. So as we incur direct labor costs on the accounting, on the books, that cost goes right into the raw materials inventory account. Okay, we're still on the job site, right? No problem, we're still on a job site. Well, guess what? We need to apply manufacturing overhead to this job site. Well, what do you mean? Well, there's indirect costs that I have that are going to apply to this job, right? There's indirect materials. Think about the nails that I'm going to use to build this house. Can I easily and conveniently trace the cost of each nail? No, I can't. I mean, I could, but I can't do it easily and conveniently. So it's an overhead cost, okay? The equipment that we use, right? I need a bulldozer and a backhoe so I can create my form for my foundation, right? That's cost on the job site. That's an overhead cost, because I can't easily and conveniently trace the cost of that bulldozer or that backhoe to each job. So I'm going to apply it on, based on the predetermined overhead rate. So we're on the job site and we're incurring all these overhead costs. Well, from the accounting side of things, okay, we're applying manufacturing overhead. We're taking it from the manufacturing overhead account and it's flowing to that work in process inventory account. Okay, so then we're at the job site. We added all the material, we added all the labor, we added all the overhead that we need. It is now a finished product. Well, what happens now? Well, once it's finished, the product then moves to the finished goods inventory account, right? It's sitting on the balance sheet. It's in the finished goods inventory account, waiting for somebody to come and buy it. Okay. From the accounting standpoint, it leaves our work in process inventory account and it flows to the finished goods inventory account. Okay. Once it's sold, once we sell that house or that product that we made, it leaves the balance sheet as a finished good and it rolls to the income statement as a cost of goods sold expense. Okay. Our period costs. Well, what are our period costs? Well, period costs are selling and administrative expenses. Guess what? Period cost is a synonym for non-manufacturing costs. Non-manufacturing costs, aka period costs, always flow to the income statement. They are not inventoriable costs. The period costs flow to the income statement and they are expensed in the period in which they occur. Okay? Great overview of how costs flow through the accounting system. Okay? Let's look at an example of the cost flow. Okay? Now let's say that, for example, we have a company here, Ruger Corporation transaction for the month of April, right? Ruger is a producer of gold and silver commemorative medallions, and it worked on only 2 jobs in April. So we have 2 jobs, job A, job B, no problem. Okay, so why are we using job order costing? Well, we have 2 different jobs. Job A is is for us to mint 1,000 gold medallions commemorating the invention of motion pictures. And job B is 10,000 silver medallions commemorating the fall of Berlin. Okay? Notice that job A was actually started during March and it was completed in April. Okay? That's important. They give us the corresponding amounts. They say that as of March 31st, job A was assigned $30,000 in manufacturing costs, which corresponds with Ruger's work in process balance on April 1st of $30,000. So that means that at the beginning of the month, guess what's sitting in WIP? Partially completed units, right? Partially completed gold medallion coins that are only partially complete. We still need to add direct labor, maybe some more direct material, maybe apply some more manufacturing overhead, right? But those costs of those partially completed units are $30,000. Job B, well, guess what? We start that in April. Okay, so we have no cost yet associated with job B. So let's see what happens. Okay, let's look at the raw materials flow, right? By the way, these are T accounts that you see here. This raw material, that's a T account. The left side is going to be the debit side. The right side is the credit side. Okay, to increase an asset, we must debit it. Bear with me here for 1 second. So the left side is the debit side, or the left side is the debit side, sorry. Right side is the credit side, CDT. Okay, now we're dealing with only assets here. Raw material is an asset account. Put an A for asset. Our manufacturing overhead, this is kind of like just like a placeholder where we apply account or apply costs, but it acts like an asset account. I'll just say that for now. Okay, work in process inventory account, that is also an asset account. Okay, for assets, we increase with the debit, we decrease with the credit. Okay, because it's an asset, if we want to increase our raw materials, we have to debit it. If we want to decrease our raw materials, we have to credit it. Okay, so let's see how the costs flow. We purchase raw materials, right? So we purchased all the gold that we needed and the silver that we needed. Okay, to do that, we're just going to debit raw materials for a certain amount of money. Okay, whatever the cost was. So then we need to recognize, how do costs flow? Well, the direct material cost flows directly to the WIP account. Okay, got to know that. Direct materials flow from raw materials into the WIP account. Okay, indirect materials, the indirect materials that we incur, flow to the manufacturing overhead account. Okay, so that's step one. If you know that, fantastic. Okay, you're ahead of the game. How mechanically do we make that happen? Well, to move raw materials to the WIP account, we're going to credit the raw materials account for the amount of our direct materials, and we're going to debit, which is the left side. Oh, that looks like a P. We're going to debit the left side of the work in process account. How do we get direct materials out of raw materials and into the manufacturing overhead account? That's simple, easy peasy. We credit raw materials for the amount of the indirect material cost, and we debit, which would be the left side of the account, the actual direct materials amount. Okay, what does that look like in journal entry form? Well, that's easy. right? They tell us that, hey, on April 1st, Ruger had 7 grand in raw materials on hand. During the month, the company purchased on account an additional 60,000 in raw materials. Okay, so we need to basically put $6,000 into raw materials by debiting it. Okay, how do I do that? Very simple. I'm going to debit raw materials. Okay, notice that we have a left column and a right column. Well, this is our debit column. It's supposed to be a D, DBT, and this is our credit, CDT. Okay. Now they said that, oh, it's accounts payable. That just means that we bought something on account. Okay. Remember, when you do a journal entry, debits and credits always have to equal. So this column has to equal this column for each transaction. Okay. So we bought $60,000 in raw materials. That means we're going to debit our raw materials account for $60,000. And it said that we purchased them on account, so we're going to credit accounts payable for $60,000. Okay? Let's look at the journal entry for our direct and our indirect materials. Okay? They tell us that during April, we have a materials requisition form. We know what that is. We saw it in chapter 2. Was prepared to authorize withdrawing $52,000 in raw materials from the storeroom for use in production. So we're going to get $50,000 of raw materials, and we're going to take those raw materials physically, move them from the storeroom, and put them on our shop floor. And we'll say our shop floor is that bucket that holds our work in process inventory accounts. Okay? They break down that 52 grand for us. They say 50,000 of that is direct material, 2,000 of that is indirect material. Okay? So we're right here in our T account, right? Oh, sorry, we're right here. We have our direct materials. Direct materials flow to WIP. Indirect materials flow to manufacturing overhead. Okay, so let's see what that looks like. Okay, well, right off the bat, we know that we need to decrease our raw materials, right? Raw materials is an asset. I see my arrow going down. That means to decrease raw materials, I have to credit it. Okay, so I'm going to credit raw materials for the entire $52,000, and we see that right here. Okay, but remember, debits and credits have to equal. Well, I need to know or remember that direct raw materials flow to WIP. Indirect materials flow to manufacturing overhead account, right? I'm increasing both of these accounts. They're assets. I need to increase them with a debit. So I'm going to debit WIP for 50,000, and I'm going to debit manufacturing overhead for 2,000. Okay? This is journal entry 2. Okay. So the next thing we need to look at is how do we record labor costs, right? Using a T account. Very easy. This is identical to raw materials, right? It's identical. All direct costs flow into WIP. All indirect costs flow into manufacturing overhead. So I incurred labor costs, right? Well, if I incur labor costs, I'm going to use my salary and wages payable account. Okay? I'm going to use this account. This account right here is a liability account. Okay? If I want to increase it, I'm going to increase it with a... That's weird. Okay. Oh, sorry about that. Okay. So here's what I'm going to do. I need to move direct labor to work in process. How do I do that? Well, direct labor is going to get a credit to the salaries and wages payable, and I'm going to debit WIP. All the indirect labor, right? That's our supervisor salaries, people that don't touch the product, that have something to do with making it, but they're not touch labor, right? We need to decrease our salaries and wages payable with a credit, because remember, left side's the debit side, right side's the credit side. So those indirect costs leave accounts payable on the credit side, and we debit manufacturing overhead for the actual indirect labor costs that we incur. Okay, let's look at an example. So in April, employees' time tickets, right? We know what the time ticket is because we saw that in chapter 2, right? It provides us with a breakdown of the employees' activities and whatnot. So we see that the time ticket included $60,000 recorded for direct labor and $15,000 for indirect labor. We got to make the journal entry, right? If we go back to here, the T account, we know that we got to leave accounts payable, and depending on if we're direct or indirect depends on if we go to WIP or if we go to manufacturing overhead. All the direct labor leaves salaries and wages payable, and because it's direct, it flows into WIP. Any indirect labor has to leave salaries and wages payable, but it goes into manufacturing overhead account for our direct labor. Okay, so we know that WIP holds all the direct accounts. WIP is an asset account. I increase it with a debit. Manufacturing overhead account, we said that behaves like a asset account, so to increase that we have to debit it with the increase it, so these two are debits. Salaries and wages payable, we're leaving there, so we're going to credit that. And what we do is we debit work in process for the direct labor portion, which is $60,000. We also need to account for our indirect labor, so I'm going to debit manufacturing overhead for my indirect labor of $15,000. I need to get basically $75,000 out of my salaries and wages payable, so I'm going to credit it. And we see here that debits and credits are equal. We're good. Okay. So now we need to look at this manufacturing overhead, right? What do we do? Well, manufacturing overhead's a special account, right? Because notice the left side, or the debit side, because the lefts are debits, the rights, or I'm sorry, yeah, lefts are debits, right sides are credits. On the debit side, we have all the costs that we actually incurred, right? All the indirect materials that we actually incurred, all the indirect labor that we actually incurred, as well as all the overhead expenses that we actually incurred, right? Things like depreciation, things like any utility bills, right? That's all our other overhead accounts. Okay, so what we need to do is we need to actually apply them. But before we apply them, we have to figure out, okay, what are our other overhead expenses? Well, we see that, would you look here? Ruger Corporation incurred the following general factory costs. Utilities, $21,000. Okay, can we easily and conveniently trace the cost of utilities to each product we make? Nope. So it's indirect. Rent on factory equipment, $16,000. Can we easily and conveniently trace the cost of rent to each product we make? No. Miscellaneous factory overhead costs. That might be things like depreciation, maybe any taxes, anything like that. We'll just run with the fact that it just says miscellaneous. The fact that we know it's indirect. We need to debit our manufacturing overhead account for the actual expense, right? So we add these up. Oh, that's bad, sorry. That equals $40,000. So we need to get all these overhead costs into the manufacturing overhead account. We increase it with a debit, which is $40,000, okay? And then how did we pay for it? Well, maybe we paid cash, but we're saying here we used accounts payable, okay? We're going to credit accounts payable for $40,000. So now we have all our costs that we actually incurred on our debit side, okay? But we need to apply these costs based on our predetermined overhead rate. And to do that, we use the left side of the manufacturing overhead T account, or the credit side, because remember, left is debit, right is credit. Yeah, left is debit, right is credit. Okay. So you guys got me all mixed up because on Monday I said something I wasn't thinking. I said the wrong words. So I'm trying to make sure I'm saying the right stuff. Or what I got in my head comes out of my mouth, rather. Okay, so applied. What do? Well, the overhead that we apply to the job, we apply it, we take it out of manufacturing overhead and we put it into WIP. Okay? Remember, actual manufacturing overhead incurred and the applied amount of manufacturing overhead are not going to be equal at the end of the year, right? Why? Well, because we're applying based on estimates, right? We might have estimated incorrectly, right? We don't have a crystal ball, so we're just making estimates, and we know at the end of the period or at the end of the year, this account is not going to be equal, meaning debits and credits are not going to be equal. What we actually incurred is not going to equal what we applied for manufacturing overhead. That's okay. We're okay with that, okay? So, let's look at the example. Let's assume that Ruger Corporation has a predetermined overhead rate of $6 per machine hour, okay? Assume that during April, 10,000 machine hours were worked on job A, 5,000 machine hours were worked on job B. So that gives us a total of 15,000 machine hours, right? So basically, we're going to apply $90,000 of overhead to the WIP account, okay? How'd I get 90 grand? $6 per machine hour times 15,000 machine hours gives us 90 grand. We got to record it. Remember, we're applying overhead, so we got to put it into WIP. How do we get it into WIP? We get it into WIP with the debit. So we're going to increase WIP with the debit, because remember, left side's the debit side, right side's the credit side, okay? And we're going to credit manufacturing overhead account to get it out of manufacturing overhead and into the WIP account. Okay? Now, what do we do about non-manufacturing costs, right? Non-manufacturing costs, or period costs, are never, ever, 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 never assigned to an individual job. Okay? Non-manufacturing costs, never assigned to a job, right? They're period costs, which means we expense them in the period in which they occur. That means that they flow straight to the balance sheet, or I'm sorry, they flow straight to the income statement. Okay, things like salary expenses for marketing, selling, administrative costs, right? Any advertising expense that were incurred during the period. That's the examples they gave us for this problem. Guess what? How do we handle non-manufacturing? Well, it's very easy, right? If we have selling and administrative, no problem. We're going to debit salaries expense, credit salaries and wages payable. Tell you what, I'm going to pump the brakes here. I'm not concerned if you know how to do this. Okay, non-manufacturing costs. Here's why. If you're an accountant and this is confusing you, talk to me. I'll be happy to walk through these with you, right? The majority of you guys are not accountants. You don't need to know this, okay? what do you need to know for the real world? Well, for the real world, you need to know this. You need to know how costs flow. Okay? You need to know that those selling and administrative expenses do not never show up on the balance sheet. They always flow directly to the income statement. Okay? I'm not worried that you mechanically don't know how to do, or if you're mechanically not sure how to make this happen, don't worry about it. Okay? I'm not going to test you on that. Because conceptually, you need to know that the period costs flow to the income statement. We're good, right? You don't need to know how to make it happen because you're not going to be accountants. You're not going to do journal entries. I'm okay with that, and hopefully you are too. But if you're anal retentive and you're like, no, I want to know this, we'll go through it. Not a problem. Just let me know. Shoot me a text. I'd be happy to go through it with you and explain it to you. Okay, so here's the next thing you need to know, right? You got to know this. Transferring completed jobs from work in process to the finished goods account. That means that the units that we produced are now completely done. They're done. They need to get out of the WIP account and they need to go into the finished goods account. How do we make that happen? Well, all the cost of goods manufactured, which is all the direct material that was incurred, all the direct labor that was incurred, all the overhead that we applied, needs to leave work in, I'm sorry about that, needs to leave work in process account and needs to go into our finished goods account. Okay? Mechanically, how do we make that happen? Easy. We debit, because we have to increase our finished goods account, and we need to credit our work in process account, right? Because our work in process account needs to decrease. So we're going to make that decrease with a credit. The finished good needs to go up, so we're going to increase that with a debit. Okay? What happens once those costs of goods manufactured are actually sold, right? Because right now, they're in the finished goods account, which is a balance sheet account. Not bullshit, BS. Balance sheet, all right? So those costs of goods manufactured need to leave the balance sheet and they need to flow to the cost of goods sold account, which is our income statement. So we now recognize the expense of the cost of the goods that we made and actually sold. Okay? Right up here, when they're in the finished goods account, these costs of goods manufactured, they are not an expense. They're still an asset to us, right? When they sit on the balance sheet like this, we say that they're inventoriable costs. They sit on the balance sheet until we recognize the sale. Once we recognize the sale, we get them off the balance sheet by crediting finished goods account and then by debiting the cost of goods sold expense account on the income statement. Okay, I know that was a long video. I apologize. But what we're going to do now is we're going to stop. We're going to start another video, and we're going to go through the problem or the study guide, the exercises that pertain to how costs flow. Okay, so please tune back in for that video.